20 grand seems like a completely normal milestone when you see it sitting in an account. It's just a number on a screen, maybe a down payment, or a few months of living expenses. But the reality is that specific number triggers a massive structural shift in how major banks look at you. A massive Federal Reserve study tracked household stability, and the data is pretty wild. Economists found that the exact line separating a highly vulnerable household from a resilient one sits right at $20,000 in liquid savings. To understand why, you have to look at the hidden internal game retail banks play to calculate your exact value to them. The resiliency line. Retail banks run incredibly complex profitability models every single day. Corporate executives have a specific name for anyone holding a balance below that $20,000 line. They call them high engagement users. In plain English, that means the people who generate the most fee revenue for the bank. The entire retail banking model relies on constantly extracting cash from people in this exact bucket. The system is literally engineered to keep you in a middle ground of financial stress. If you're completely broke, the bank can't make money off you because you don't have the funds to pay their penalties. If you're super wealthy, you move your capital into treasury ladders or private brokerages where retail fees can't touch it. The sweet spot for the bank is when you're just stretched enough to stay vulnerable, but fully employed. Staying under 20 grand keeps you perfectly locked in that matrix. The 5 layers of extraction. The primary way banks bleed these accounts is through overdraft fees. We're talking massive numbers here. Banking institutions dragged in over $7 billion in overdraft penalties in a single year. And the wildest part? A tiny group of under 10% of account holders paid nearly 80% of those fees. The software is literally optimized to target vulnerable people. Engineers build transaction ordering algorithms that reorganize your daily purchases behind the scenes. If you have multiple pending transactions, the system processes the largest dollar amount first. That intentionally tanks your balance into negative territory instantly. Then, every single small purchase after that triggers its own separate overdraft penalty. It's a deliberate engineering choice to maximize retail profit, and banks have paid billions in class action settlements because of it. Then you have compounding credit card interest. Federal Reserve data shows the average household carrying a balance pays over $1,300 a year in interest alone. When rates climb past 25%, it absolutely destroys your monthly cash flow. Most people get trapped here because they don't have a cash buffer for emergencies. A sudden car breakdown or a medical bill forces them to lean on high-interest plastic. Once that emergency hit happens, the balance sticks around. It eats up the next month's surplus, so you can't clear the statement. The credit card industry explicitly calls these profitable clients revolvers because their debt just keeps cycling. On the flip side, if you pay your balance in full every month, the industry calls you a deadbeat. Yeah, they genuinely use that term because disciplined users don't generate interest profit. On top of that, you get hit with routine monthly maintenance fees. A standard checking account will quietly chip away $15 a month unless you hold a specific minimum balance, usually between $1,500 and $5,000. The second you have an irregular paycheck or a tight month and dip below that line, the bank hits you with a penalty for being vulnerable. But the worst part isn't even the cash, it's the cognitive toll. Elite university studies measured the mental impact of chronic financial anxiety, and the data is terrifying. Enduring that kind of stress drops your cognitive performance by 13 full IQ points. To put that in perspective, pulling an all-night sleep deprivation session only drops you by about 8 points. This constant background anxiety literally drains your mental bandwidth and warps your long-term decision-making. We bridge the mental drain of being broke directly into the macroeconomic trap the bank sets for your cash once you actually save it. The cheap capital traps. But there is an even deeper reason the system panics when you cross that 20 grand line, and it brings us to the final, quietest layer of the entire model, the cheap capital trap. Up until this point, the bank's algorithm has been trying to actively bleed you for immediate fee revenue, but the exact second your balance ticks over 20,000, the system realizes the predatory extraction game is officially over. You are no longer generating penalties, so the institution immediately pivots to its secondary defense mechanism. It wants to freeze your cash. Banks don't actually keep your money sitting safe in a vault. They run on fractional reserve banking. That means for every single dollar you leave sitting idle in a basic checking or savings account, earning a pathetic 0.01% interest, the bank is legally allowed to lend out 10 times that amount to other borrowers. They turn around and weaponize your hard-earned 20 grand to fund high-interest auto loans, commercial mortgages, and corporate credit lines. When you don't know any better, you leave that money completely stagnant. You think you're being safe. In reality, you're giving the bank the absolute cheapest, heavily subsidized capital they can get their hands on. The real panic for the institution isn't just losing a $15 monthly maintenance fee. It's the realization that you might actually wake up, pull that 20 grand out of their retail ecosystem, and move it somewhere that actually pays you to hold it. The second you do that, you break their leverage chain. The outside option value. Behavioral economists talk about a concept called outside option value, which is basically the leverage you get from having a real exit strategy. When you have actual cash reserves, your position in every single negotiation, professional or personal, goes through the roof. The other side can instinctively feel that you aren't desperate. Desperation shows up in your posture, how you speak, and what kind of garbage conditions you're willing to tolerate. A real cushion changes your physical presence. It lets you hold silence in a high-stakes room and control the conversation. If you look at how bank branches actually track profitability metrics, the highest margin clients are rarely the richest people in town. The most profitable accounts belong to the people who earn decent salaries but stay completely dependent on basic retail banking. They're consistently paying transaction fees, car loan interest, and rolling credit card debt. Truly wealthy people only step into a retail bank branch for quick operational logistics. The entire retail consumer setup lives off the habits of people with less than 20 grand in savings. Now, when regulatory pressure starts cracking down on predatory fee structures, banks are forced to pivot toward building long-term customer relationship value. Accounts with higher average balances might generate less immediate fee revenue, but they're incredibly stable over decades. Ultimately, the highest franchise value for any institution comes from well-capitalized, resilient accounts. The math of financial posture. Let's break down the exact mechanics of shifting your financial posture. Imagine an average professional making around $68,000 after taxes. That's about $4,400 a month take home. If fixed costs, rent, car, insurance, utilities eat up $3,200 and lifestyle expenses take another $500, that leaves a net surplus of $700 in a perfect month. The trap most people fall into is letting their savings sit static at a low number, like $4,000. Every single time a little extra cash accumulates, a car repair or a home emergency wipes it out. To break that cycle, you need a strict structural separation. You open a high-yield savings account at a completely different bank with a unique login and automate a transfer for $500 the exact day your paycheck hits. Within a year, that balance climbs past $10,000, even with an unexpected repair. By month 20, you cross the $20,000 milestone, and that's where the massive downstream cascade hits your whole profile. Your credit card utilization plummets, say from 42% down to 9%, because your operational checking cushion means you never need short-term borrowing. That drop alone can spike your credit score by over 30 points in 60 days. You then weaponize that higher credit score to refinance your debt. Dropping a car loan interest rate by just 2 percentage points can instantly save you over $1,200 in future interest. At the same time, you can safely raise your insurance deductibles because you actually have the liquid cash to cover a hit. That single structural tweak can easily drop your premiums, saving you another $700 a year. The premium on complete simplicity. The financial services industry loves to wrap basic wealth concepts in layers of fake complexity. Advisors will try to drag you through complex asset allocations, constant rebalancing schedules, and alternative products just to justify their management fees. A straight shooter will tell you the real play. Secure your $20,000 liquidity buffer first, then dump every single dollar of future surplus into low-cost index funds. It takes zero active management and leaves no room for corporate advisory fees. Look at the historical market data. data. The standard index tracking the biggest companies averages about a 10% annual return over the long haul. If you put 100 grand into a basic index fund at age 35 and leave it completely alone until 65, it compounds into roughly $1,749,000. But you can only capture that massive compounding growth if you have absolute patience and zero immediate emergencies forcing you to liquidate your positions. That patience is only possible when you have a permanent liquid buffer shielding your investments. You can start this transition today. Calculate your exact bank extraction rate over the last 12 months. Go through your statements and add up every overdraft fee, account charge, and dollar of high-interest credit card debt. Most people without a solid liquidity reserve realize they're losing thousands a year to these invisible leaks. That number is the literal cost of the gap between where you are and the resiliency line. Cutting those leaks immediately speeds up how fast you build your core $20,000 buffer. Get that dedicated high-yield savings account set up at an external bank to maximize your yield and create some positive friction. Right now, competitive high-yield accounts pay way more than standard retail checking, handing you hundreds in passive income on a 20 grand balance just for picking the right vehicle. Ultimately, look at your liquid cash as the direct metric of your outside option value. Keeping 3 to 4 months of living expenses completely changes your posture, turning every professional conversation into a negotiation from a position of absolute structural strength. The retail banking toll road is always open, and it's perfectly optimized to bleed undercapitalized accounts. Your single goal is to build an independent bridge that bypasses that system entirely. Once you cross that $20,000 threshold, you get your full cognitive bandwidth back, and you gain permanent leverage over your financial future. Take control of your numbers, build that liquidity buffer, and stop paying the price of being financially vulnerable. If you feel like you've learned anything today, you could do me a solid by hitting that like button, subscribing to the channel, and letting me know what you think in the comments sections. Until next time, stay grinding.